Most traders know the popular price oscillator like stochastic, the relative strength index, and so forth. But few traders know about the use of the value oscillator, a far more important category. While price oscillators are used mostly to evaluate overbought and oversold price conditions with the high and low percentage rate, value oscillator can help identify the entry behind the move. Value oscillator can expose market inventory of the all kinds as well as reveal the shift of energy from up to down and vice versa. Being able to identify an increase in the value or a shift in direction can help sort them. Trades determine the duration and the sustainability of the current price action. This can also help screen out weaker stock picks and ascertain when to exit a trade. It's today institutional activity-based market. The volume oscillator can reveal buying and selling patterns before price being a major move. This is because many of the large institutions are careful not to disturb price as they buy incrementally. The standard value oscillator available for most charting software is center line oscillator. Instead of the oscillator between a high range and a low range, the way most price oscillator do center line volume oscillator move above and below the zero line. The center expose oscillator volume energy behind the price's actions for the both buy and sell sides. The volume oscillator consists of the two moving average of volume. The fast one shows the fast volume moving average is then substance from the slow moving average. If the fast MA is above the slow MA, the oscillator will be positive. If the fast MA is below the slow MA, the oscillator will be negative. By watching the volume oscillator, you can take your projections to a move analytical level to replicate price changes before price reference on the test short-term trend and being able to anticipate price actions well ahead of the event. It's adventure when the market is moving with velocity. So how do when to use it? There are numerous ways you can use a volume oscillator to speed up your trades analysis. The volume oscillator is the easy to read because it's the center line. As the volume indicator moves above to the center line, it indicates volume or the resistance interest of the stocks to buy side. As long as the indicator remains above the end or oscillator near the center line, buyers will dominate stocks activity and bias will remain the upside on the short-term trend. When the volume oscillator hits down and moves well below the center line, a distribution or the selling pattern is occurring. For short-term trading, this can be a profit taken after the big up move. A positive value suggests enough market support exists to continue driving price activity in the directions of the current trend. A negative value suggestions of the lack of the support indicates that the price may become the standard or reverse an increase or decrease in the price fluid by the increase in a volume may be considered the site of the strength in the prevalent trend. Therefore, when the fast volume moving average that for 14 period is above to the show volume moving average that for 28 period. The volume oscillator is above the zero line may be confirming price direction whatever it be up or down, and increase or decrease in the price fluent by the decrease in the volume may be considered a sign of the weakness in the prevalent trend. Therefore, when the fast volume moving average is below The volume moving average, the volume oscillator, is being the zero line, maybe a warning that the price direction is like in strange convention. Is the chart the fact that the price is making higher heights and higher lows might be volume by May trades the bullish side. When the price increase is combined with the volume oscillator making the higher heights and higher lows, a trade may consider this even more bullish. On the daily chart example, as the price moves up during this period, the volume oscillator pattern from the lowest heights indicators a weakening of the upside energy. So when the price was increasing, the volume oscillator was not confirming the price movement because it was decreasing, making repeated lower highs and lower lows. This bearish divergence indicates that the recent price increases were not being made with the volume strength. By studying these patterns carefully, you can anticipate and prepare for the reversals and the retracements prior to the price actually changing. For this reason, the volume oscillator is the great confirmations indicator you can use to confirm a breakout of support and resistance. For example, a breakout of resistance which gets hand of the head with the increase in volume indicates a strong move. This is a great spot first breakdown. In this second example, we have the breakdown to the downside. Noticed how the price approached the previous slight low and the volume oscillator spikes higher. The way you should read this is the amount of the selling pressures increase on the rest of the second low. However, the volume oscillator will provide a ton of the false signals when the market is the fine range. The price and volume actions will look non-existent, yet the oscillator could be moving above and below the zero line. This is really annoying because the appearance of the underlying strength or weakness is nothing more than the false signal. For this reason, I like to use the volume oscillator along with the price oscillator. Contraction price oscillator, one of the most important advantage when using the volume oscillator is conjunction with the price oscillator, such as the stochastic or the RSI, is when the contractions occurs between the volume oscillator and the price oscillator. Such contractions are known as the divergence or convergence between the indicators. In this chart, you can see the example of the contractions between the stochastic volume oscillator. The stocks is a booming platform, which is a common sideways pattern that develops as institutional investors move into the stock without moving price out of the thin range. Industrial investors are the most domain of the market, particular groups, and their activity often goes unnoticed because they are controlled background order and maintain price central levels. Stochastic oscillator is dropping below its overbought 80 lines, while the volume oscillator is healing upward as platform develops. This creates divergence patterns between the stochastic and the volume oscillator. This pattern is warning indicators that the platform will break the upside, which can be critical piece of the information for the positions of the swing traders. IN is this example. The stocks formed the platform during the several months. Stochastic was the overbought during that period, then slipped downward during the platform stage. However, the volume oscillator continued to rise during this period, followed by the upside breakdown move during the moderate daily trending markets when the most price oscillator failed to oscillate but from the floater pattern at their overbought line. A volume oscillator can be an invaluable analysis tool for the swing and positions traders exploit weakening price actions before the recent. This chart shows the spike in the volume oscillator during the platform and prior to the move up. This is the indicator of the heavy industrial investor activity that tend to use the control breakout orders that do not move price during the accumulation phase. As the stocks moves up, the volume oscillator hovers around the central line indicator. Strategy consistent volume activity until the volume oscillator suddenly forms a divergence with the price just prior the topping actions. Volume oscillator and the gaps platforms and bottoms often gave huge up gaps due to the industrial short terms and high frequency trades who trade aggressively when they discover that their counterparts, the institutional investors, has been accumulations. They a large of the speculating buying patterns drive price ups in the sudden explosion move. The volume oscillator can be a useful tool in finding the stocks positive for the huge gaps. In this example, you see the overbought stochastic as the volume oscillator turns upwards and moves above its central line. Although price is sideways, volume is the buying energy during the bottomic phase, and here's the gaps that forms shortly 3 or 4. The volume oscillator indicate that heavy buying activity prior to the huge gap. By using the volume oscillator with the stochastics right and movement, traders are able to entertain the stocks prior the gap's price actions, thereby increasing their profits significantly. That's why the volume oscillator can be an additional analysis tool to use with the price oscillator to help explore the strange or weakness volume patterns that often precede change to the price actions and directions. As with all indicators, the volume oscillators require study and practice to use the properly and learn in now, since extreme oscillator patterns can reveal shifts of the sentiment and bias from the buyers to sellers and from short sellers to buyers. The indicator is ideal for short-term trading systems and can show buying patterns of the industrial investors during the platform makes markets when the price actions appear to be range bound. However, the volume oscillator is an advantage indicator and should be used by the traders who have some trading experience and a short knowledge based of the price oscillator and other indicators. Beginner traders, however, will need to first learn price oscillators and various volume indicators before attempting to use the volume oscillator. If you find the value to learn something new, leave us a like and show your support, and make sure you subscribe to click the bell icon to stay notified when we release the new videos. Until next time.